Well, welcome everyone. I have 1 o'clock London time now, so I think we'll get started. So today's webinar is going to focus on Africa. I'm Eric Anderson. I'm the head of emerging market investments at Milltrust International, which is a London and Singapore-based asset manager with a core focus on delivering global emerging market investment solutions to investors. For today, after a very brief introduction from me, we're going to hear from the Africa investment manager, Laurium Capital, an independently owned asset manager that has been investing successfully in Africa since 2008, and is actually one of the few firms that have a research team analyzing stocks on a Pan-Africa sector basis. This is different than the peer group, which tend to either look at strictly South Africa or Africa ex-SA, or have separate teams doing the two different universes. Laurium are fundamental bottom-up stock pickers at their core. They look for high conviction long-term investment opportunities, as well as market inefficiencies in Africa to build a high conviction portfolio. In order to provide this Pan-Africa solution, they have boots on the ground, extensive knowledge and strong relationships across the continent. They also bring a macro top-down overlay to help navigate the opportunities, which is complementary to the bottom-up research. Today, we're going to hear from Murray Winkler, the former CEO of Deutsche Bank South Africa and one of the co-founders of the firm, as well as from Dwayne Dippenaar, the assistant PM for the strategy. After the core presentation, we'll then have the opportunity to open up to questions from the listeners. You can ask questions by using the chat box in the Zoom panel. We're going to try to keep this at 30 minutes, so if we don't get all the chance to answer all the questions, we'll follow up directly afterwards. And just before handing off to Laurium, just a quick overview on how Milltrust fits in. Our approach at Milltrust is to identify leading locally based investment teams in each of the core countries and regions across the emerging markets who are specialists in putting together high conviction portfolios of high quality companies. Each specialist team, which you can see here on the map, manages their regional portfolio within a sub-fund on the Milltrust Emerging Markets platform. These sub-funds form the basis of our global EM strategy. Investors can either invest directly into the sub-funds, such as the Milltrust Laurium Pan-Africa Fund, and build their own exposure to these countries or regions, or invest with the Milltrust Global Emerging Markets Fund, which allocates across the sub-funds of the platform. I think that's enough for me. I'll now hand it over to Murray and Dwayne. Over to you, gentlemen. I think if you can get off mute, Murray.
There we go.
There we go.
Hi, Eric, can you hear us there?
Yes, perfect. Go ahead.
Sorry about that. It was a technical problem. And thanks, Eric, and good afternoon, everyone. We're going to have a look uncovering a couple of gems in the rest of Africa, starting with the South African outlook. Now, broadly setting the scene on the macro growth story, basically South Africa wasn't doing very well going into COVID. We were growing around 1%. The blue line here shows our projection of GDP growth rates, and that's where we were meant to go to 2023. COVID came along, we were growing between 1% and 2% and gave us a really big thump, and we ended up going down backwards 7% last year. Now, we were able to use monetary stimulus, but the situation of the country, we didn't have much fiscal stimulus, unlike the US, that was able to throw over the last 18 months some 23% of GDP, fiscal stimulus with 23% of GDP. We had very little to do. Notwithstanding that, we thought beginning of this year we'd grow to bounce back about 3.5%. Things do look a little bit better, and we'll get into that. And on the right-hand side, what we do show base to 100 in 2019, various sectors in our economy. The one up here at the top is agricultural. We're having a phenomenally strong rebound in agriculture this year. Our mining is doing extremely well, and some of the other areas, well, obviously, if we look at electricity, transport, and tourism, pretty poor. But some of the sectors, important sectors, doing pretty well. In terms of the fiscal situation in South Africa, now this might look bad relative to some other countries out there. We were running pre-COVID 63% debt to GDP. Now, for emerging markets, that's relatively high. COVID struck, and the next thing we were up at 80%. Projections, if we go back to medium-term budget, which was middle of last year, the projection was debt to GDP would get to 24, 25, down to 95%. Subsequently, what has happened with these rebounding resource commodities, which South Africa is a big exporter, we've seen revisions downwards earlier this year, and we now look like we'll be below 90% or so. So there's some positive news at the margin, and things are surprising quite nicely, but we do have some long-term structural issues that we need to deal with. This chart here, which a lot of you will have seen before, the commodity prices, CRB Index, we're going back to June 2006, and the last sort of 15 years. You can see since middle of last year how strongly the CRB Index has gone up. We're up some 60% and almost back to highs that we were in 2011. Particularly for South Africa on the export side, the PGM metals, which is platinum, palladium, rhodium, are our biggest exports at the moment. We have iron ore, we have manganese, which are doing well as well. But one of the products out here is rhodium, which has gone up 30-fold in 5 years, and particularly in the last year and a bit. So we are on quite a sweet spot from the metals point of view, which is helping a lot. So if we put that into context, here we go. If we go back, this is a long way back in history, 1960. This is our current account as a percentage of GDP. And we look from 2000 to 2020, you can see that we've averaged in that period a current account deficit of generally around 3.5% is where we've been. But what has happened with the commodities, being in the sweet spot with commodities and aggregate to a lesser degree, our current account surplus in end of last year got up to 2%. Our trade account in the end of this last quarter, Q1 this year, got up to 9% of GDP. Phenomenal number. We predict, and Q1, this number is now up at 5%. We think this will be around 5% for this year. So very, very powerful in supporting the currency at the moment. And while the Rand's been in emerging markets, year to date, it's been the strongest performing currency. So this keeps, particularly in the short term, looking out the next 6 to 12 months, a very strong current account surplus is going to ensure that the Rand is relatively strong for the country. So as a result of all of this, we've had revenue collections which are surprising on the upside, which is from these high commodity prices. And what we show over here on this chart is the weekly domestic bond issuance, that because obviously if you're funding the deficit, which is sort of sitting at 80% of GDP, the bond market, fortunately with most of our funding is done in the local market, probably more than 85% of our funding is done locally. So we don't have that big dollar debt. But what has happened since middle of last year, towards the end of last year, government was issuing 10 billion Rand on a weekly basis. Treasury has just recently revised this further down this year, that now we are at only $6 billion rands a week. So from the funding point of view, things are going quite well in South Africa. So the cyclical bounce back, because of commodities in particular, is pretty powerful. So if we to summarize in South Africa, economy is rebounding decently off its lows. We think right now, our best guess, we probably bounce back 4%. So it's nothing like global growth or like the US, which could do 7%. But from where we were relative to expectations, 4, maybe 4.5% is a pretty decent number. On the political side, which has been a huge issue with our President Cyril Ramaphosa, he's moved very slowly. But in the last 2-3 months, there's a lot of corruption in government. He's been making some moves, and the ANC Secretary General is basically is stepping aside, put on leave, no part of the top 6. So that's pretty positive. We've had some deregulation also recently in the last couple of weeks on our energy sector, where private government controls us. And what they've done, from allowing without a license, they're now allowing the private sector to generate its own 100 megawatts, which is very positive for future fixed investment spend. You could get a special permit to do 50, but that was very hard to jump through the hoops and make that happen. And now they've opened this up literally that you can do 100 megawatts with on a very small regulatory requirement. So that we see as quite positive. Our state-owned enterprises, South African Airways, you might have also recently seen sort of privatization of that, or at least government will hold less than 50% of it, which is a positive move. So at the margin, some positive stuff happening. We have a long way to go still, but pretty positive what is taking place at the moment. So if we look at valuations and come back to the markets, and we look at the 1-year forward PE multiples, what has happened. At the top here in yellow, you can see this is a 1-year looking forward multiple of the S&P, which is around, on consensus numbers, 22 times. You look at the MSCI World, which is up here, pretty high numbers. And you come down to the bottom, and there, of course, is South Africa. So we've seen a massive derating taking place from 2018 to extremely low levels. So the outlook, people have been quite pretty negative. The outlook fundamentally not great, but cyclically we are doing quite a lot better, and we think it looks pretty attractive on valuations now. So we're under 10 times multiple, the MSCI South Africa Index at the moment. And we'll delve into a couple of sectors which we think look really good. Now, if we look at Africa's ex-South Africa as well, space that we obviously cover and play in, look what has happened there. So here again, we go back to Feb 20. That was just before, I guess, the onset of COVID, and markets collapsed. And we've seen a very strong bounce back. Now, at the top of the pops again is the S&P 500, up here, some sort of close to 30% up from pre-COVID levels. South Africa's bounced pretty well. So because of a lot of our metals plays, some of the international stocks and some of our banks, we've bounced sort of to 10% up from where we were. The laggard has been the rest of Africa, which forms part of the frontier markets, and that is still about 85% of where it was. And we'll delve into a little bit why we think that is. So frontier markets, no one is interested in frontier markets at the moment. It's all been really the developed markets. Okay, this chart, if you were on our last webinar we did a while ago, we talked about COVID in Africa. And the one big thing, if you look at the two pyramids here, this is the pyramid of Africa. Young, growing populations, a normal distribution. This is in Europe. You can see this big blob here. Not that many youngsters, a lot of oldies. So we got lots of youngsters growing in our economies. And if you have a look, 60% of Africans are below this chart, this bar here. 60% of them are below the age of 24, whereas 27% Western Europe. And over the age of 65, only 4% in the whole of Africa, compared to 21% in Western Europe. And that's why we've seen COVID cases. Now, maybe the reporting isn't that great, but particularly in Africa, non-South Africa, the amount of deaths has been pretty low. And the other thing that has happened, because this is a young emerging populations, they haven't had shutdowns as well. So the growth rates last year they didn't get hit nearly as hard as a lot of the developed economies. So here we have the chart of historic GDP numbers going back from 2014. But if we focus on 2020, so South Africa, we said, was -7. And the other one developed is Morocco, which was also -7. So they're relatively well-developed, more formal economies. Egypt is a lot more informal, Kenya and Nigeria. So Egypt was actually up 3% last year, whereas Nigeria and Kenya were only small down. So they didn't get hammered as much. They did have some lockdowns in Kenya, but the impact of this informal sector being so big protected them quite a lot. More importantly, what about the bounce back? So we've talked about SA3. This is the IMF numbers. In our view, it's likely to be 4.5%. Egypt is following last, is not bouncing back as much because it was pretty strong last year. But Kenya's, which has grown very strongly, is projected to grow around 7% this year after being flat last year. And Morocco will do quite well. Nigeria is struggling a bit, notwithstanding the oil prices. These numbers look a bit on the light side to us. But there's some decent numbers coming out of these countries. But what is very exciting to us is the valuations that we look at in some of these stocks in these countries. If we look at the MSCI Africa, non-South Africa relative to EM, and this is going back to 2008, historically we've traded a slight parity to EM. Now, EM has got a lot more China and Taiwan in these days. But we're trading down here at about a 0.8p relative as a whole in Africa. So valuations look quite decent, but particularly one or two little stocks that we think look very attractive, which we'll have a look at the fund positioning and then go into the stocks. And Dwayne will take over on that side.
Great, thanks, Murray. So if we just look at how our fund is positioned at the moment within the African and South African listed space, first and foremost in the global consumer space, we have quite large positions in British American Tobacco and Raynet. I mean, currently the stock's trading on an 8.4p and an 8% dividend yield, and we think you can see mid-single digit earnings growth, and it's delevering its balance sheet quite aggressively. So by the end of this year, we think you'll see decent buybacks from the company. So we think it looks very attractive at the moment. We have a large position in naspers. I mean, the real driver for the naspers investment thesis is still Tencent, which is trading on a 24 PE. If you take the associates out of that PE, which don't contribute any earnings to Tencent, and it looks very attractive with earnings growth, we think of at least 20% CAGR going forward. On top of that, you're buying into naspers at over a 50% discount. And we can discuss the latest deal and what our thoughts around that deal is a little later. If we look at the South African financial sector, we still have a large investment in the South African banks. They're trading well below their historic price to books and below 1x price to book. We think going forward, the ROEs will pick up and will be well above the cost of capital. Plus, you should see decent dividends coming out of the banks. And recently, they've released quite a lot of provisions, so they're looking very attractive. We've also invested in South African insurance sector on basically a price to embedded value basis. They're looking very cheap, and we think their balance sheets can survive this COVID or third wave of COVID pretty easily. And you should see very decent dividend yields coming, sort of high single-digit dividend yields going forward out of them. If we look at healthcare stocks, we've got two healthcare stocks there, Netcare and Mediclinic. Right now, the healthcare stocks have been knocked quite badly by COVID, but the hospital groups have handled it very well, have very strong balance sheets, and are trading at about 8 EV/EBITDA. So compared to their peers and their history, are looking very cheap. Select resource exposure, there we prefer PGMs, have a decent exposure to PGMs. We think while the prices look elevated, if you look at the supply-demand dynamics around that sector, it looks very attractive. Obviously, it plays into the greening economy, which is great with catalytic converters on cars. And you've seen very low capex going into mines in Russia and South Africa, where a majority of PGMs come from. And thus, we think going forward, there is supply constraints. So we think that PGM metals are well supported. And then on diversified miners, trading at very high free cash flow yields, so 15% free cash flow yields. So look attractive from that point of view, strong balance sheets. We think you should see good dividends coming out of the diversifieds, including special dividends. But we are there watching quite carefully some of the commodities like iron ore, which is really subject to what happens in China and maybe a bit of a slowdown in the second half in China. Other than that, in Africa, ex-SA, we've got some very interesting ideas, most of them sitting in Egypt, Kenya, and Morocco, because they've got stable currencies, we think, going forward, and very good growth prospects. If we just look at naspers and where it's traded compared to discount to NAV over time, we can see right now it's trading at about a 52% discount to NAV, which is relatively wide compared to its history. We did see it narrowed a bit after the first process deal and has widened subsequent to that. I mean, as I said over here, the true driver, or 85% of the intrinsic value, is still really driven by Tencent, which we could discuss in more detail, but we think looks very attractive. Their rum portfolio really consists of classifieds, which has now become profitable and looking great. E-tail in Eastern Europe also just become profitable. So both of those divisions, we think you could see a listing, let's say in the medium term, which could unlock some value. And then they've invested heavily in food delivery and edtech, which is both really exciting spaces. And the IRRs they're seeing there are quite great. And I mean, on top of that, you're buying into all those assets at a 52% discount. And while the current deal they put on the table was not what we expected, and we didn't think it was ideal, we do think going forward, you'll see a second step to that deal, which could help narrow that discount. We look at the South African healthcare space. Discovery, which is the largest medical insurer in South Africa, believe that 62% of South Africans have already had COVID, and the South African National Blood Service said in January of this year that 52% of the blood they test has COVID antibodies. So COVID really has been relatively widespread in South Africa already. If we look at excess deaths, there's been 40,000 or close to 50,000 reported COVID deaths now, and 160,000 reported excess deaths, and they're highly correlated to the first and second COVID waves. So you can see that it is very probable that COVID's been much more widely spread than has been reported. If we look at this graph on the bottom left here, we can see one of the hospital groups that we own, where their occupancy sat before COVID. You can see it dropping down as we go into the first wave of COVID, as hospitals open up many beds for COVID patients. But the wave was quite slow and came later. So for quite a while, the hospitals sat at low occupancies. And obviously, they got high operational leverage with high fixed costs. So this hit the bottom line quite badly. You can see in the first wave over here, the hospital groups being very worried, made 80% of their capacity available for COVID patients, but very little of it was actually filled. Whereas going forward, they've become smarter in the way they allocate beds and only made 60% of the capacity available for the second wave, which was largely filled, and obviously has pushed the occupancy and capacity utilization in the group up. And we can see here, once again, the capacity utilization in the hospital group picking up as elective surgeries come back. Because they've got smarter in the way they handle the pandemic, and we've seen elective surgeries come back, we think they can get back to their pre-COVID level of earnings in the next 12 to 24 months. So if you look at the balance sheet, they can easily weather the next third wave, very strong balance sheets. They're trading on 7 to 8 EV/EBITDAs, which look really cheap compared to peers globally and in emerging markets. And we think you should see a good tailwind for earnings recovery going forward. So very attractive opportunities in the South African healthcare space. If we look at the resources space, I mean, over here, we've listed our platinum group metals mining. So Impala, Sibanye, Northam, and Amplats. You can see all of them at spot prices trading on very, very high free cash flow yield. So almost 20% free cash flow yield. So looking very attractive at spot. Obviously, I mean, the commodity prices have been well supported by China and the strong demand of that after it recovered post the first wave of COVID. We've seen supply issues, especially on the PGMs, but also in iron ore out of South America. And then, of course, we've got global GDP recovering into 2021 globally. So that's all really supported the current commodity prices. The risks we see, while you see very favorable momentum in the short term, with all the commodity prices quite high, on a long-term basis, many of the commodity prices do seem very elevated. Something like iron ore, if you looked at the 90th percentile, the cost curve would be down at $65, $65 to $70. It's trading at over $200. So we would have thought on a long-term basis, you would think the commodity prices have to come back. It's really about but short-term momentum, very high free cash flow yields. On the platinum group metal side, I mean, you would have to see supply come back to the market, and that will take at least a year to 2 years. So we still think over there, good support. The other thing to watch is obviously reduction of stimulus in China, which we could see in the second half of this year. The South African insurance space also looking very attractive. This is Momentum and Liberty, both stocks we own, trading well below 1x group equity embedded values, very strong balance sheets. They've provided quite well for mortality and persistency. So we think they're well provided. And we know what their back book looks like. Back book continues to grow. So we know that they'll have very decent cash generation and should be able to pay out decent dividends.
Okay, yeah. All right, two of the stocks that we own that if we're looking in rest of Africa, East African Breweries, which is Kenyan-based EABL, Kenyan-based manufacturer of beer, spirits, and non-alcoholic beverages. Why we like it, it does have the parent DHO, so it's the regulatory stuff and the corporate governance is a lot higher than some of the other companies out there. And what has happened to what we show is that F19 at the halves, 42 billion of sales, big smack up that happened in 2020, that bounced back to similar levels where they were in 2019. And if you look since the last 7 years at the where this is traded on a 1 year forward multiple, historically it's traded about an 18 times multiple. You're able to pick this thing up now on a 12 times. I mean, it's literally a 35% discount to history and as cheap as it has been. And they put in new capacity expansion as well in the last couple of years. And we think we could quite easily see this multiple move back to around the 13, somewhere between 15 and 18 times quite easily in the next year or so. So it looks very attractive to us. One of the other areas is Egypt that we think looks very attractive. And then particularly the one sector is the banks. So on the left-hand side, we're based to 100 from March 20. How EM banks have done, they're up 40% or so. If we look at the Egyptian banks, the two that we own, Credit Agricole and QNBA, they're down sort of 20% and 90%. So relative, pretty big underperformance. On the right-hand side, what we show is the price to books of these, both of them trading at a 0.9 price to book at the moment. Now, bear in mind that these generate ROEs of above, on a normalized basis, between 20 and 25%. And the cost of capital, the cost of equity is probably running at about 16% or so, 16, 17%. And they have traded, the dotted lines show where they've traded historically. Relative to current book values, they're trading also about 35% discount to their history. So very attractive on valuations. And the earnings, if you look out on a 3 year basis, both of them we think will grow their earnings anywhere between 15% and 25% compound earnings growth. So looking pretty attractive out there. So in summary, obviously the global fiscal and monetary stimulus growth is pretty good, supportive, which again, strong global growth is good for EM risk assets, which filters down to SA. Rest of Africa is frontier, so it could lag a bit, but very attractive valuations. And for South Africa, we need big structural change. We are having slow and steady structural change, is what I say. So the last 6 months, we've seen some decent stuff after being smacked by COVID. And I think on valuations, we're finding some pretty interesting opportunities and stocks out there still at the moment, despite a bit of a bounce back. So with that, I'm going to pass back to you, Eric, and we can take some questions.
Great, thank you for that. Yeah, we do have a number of questions here, which I'll combine into shorter questions. So one is on commodities. Obviously, we've seen the run up. You show some great graphs there showing the very sharp move. And you've talked about some of the short-term risks and long-term opportunities and short-term opportunities. How is commodities in the portfolio? You know, how much of the portfolio is in commodities? And do you see that changing over the short to medium term, that exposure changing based on the risks you mentioned and what the Fed's been saying, et cetera? So is that position in the portfolio going to change, you think, in your in commodities in your portfolio?
So, I mean, in total, there's about 20% of the portfolio that's in various commodities, of which I think it's about 8% in platinums and 8% in diversifieds, and the rest is in something called SAPI, and there's some oil exposure there as well. I mean, at the moment, especially on the platinum side, you could see us increase our exposure. The platinums have pulled back recently, so we starting to see opportunities there again. So you could actually see that increase. On the diversified side, we are probably slightly more cautious. But I mean, if we look at the diversified, we own Anglo and Billiton. Both are starting to look very attractive. They pull back slightly, but we think there's, very strong dividends or special dividends, in fact, going to come out of both stocks going forward. So on an Anglo side, which has got a slightly more exposure to diamonds, which has been well supported, you could see us adding a little bit, but probably a little more cautious on the diversifieds and with a view of adding to the platinum side of things.
Yeah, maybe to add there, on the platinum, on the supply side, looks very good going forward. With the shortage of chips at the moment, you can see the sort of demand side has hit them a little bit, which is coming through now. But if you look at the demand supply fundamentals and roll forward the next 18 months, there's no real new supply coming out, and we think it looks pretty attractive. So Dwayne says we probably add to that. And obviously, we've seen a bit of these have rallied very strongly. We're seeing a bit of a pullback at the moment in some of these resources following the Fed bringing forward if you look at the dot plot, the fact that rates are coming, maybe going to rise sooner than later. But our view on that is we're having a little bit of a pause at the moment. Maybe it's a month or two, bit of a pullback after a very strong rally in these commodities. And into that, I think we would be looking to actually increase some of the exposure there.
Okay, well, that's great to hear. Another one is on currencies, on the Rand. I know you're bottom-up stock pickers, but you have a view on where the Rand is and the expectations for the currency.
Yeah, okay. So forecasting the Rand, as you say, is we know we're going to get that wrong. But I think we can look on a long-term basis, fundamentals, PPP, etc. If you depends your start date, always how you look at it and the factors you take into account. But broadly, you get PPP at around sort of 1450 is where you would get fair value on the currency. Now, historically, we've traded at big premiums and big discounts to that. And our currency, we were sitting down at 1350 literally 2 weeks ago. We've bounced all the way back now to 1425. Our view is if you look out the next 6 months or so, I think there's a very good chance that we see the currency will remain relatively strong and strengthen from here. Linked to that, obviously, is how the dollar-euro performs. So for what it's worth, our view on that is we're likely to see the dollar weaken towards 125 against the euro. That's been our number that we've plugged in. So if that happens, we've seen a bit of strength now. If that happens, I think that there's no reason why we can't retest the 1350 levels on the currency. But that is slightly overvalued. But I think you saw the current account numbers there, very strong current account surplus is going to keep the Rand relatively strong, we think, in the next 6 months or so anyway.
Yeah, certainly that current account graph is very telling. So, and then I want to keep this to 30 minutes. So I'm just going to do one more question here on naspers and process. I know you a bit more on that sort of deal they announced. Obviously, I think the market didn't like it that much. Perhaps more complicated than maybe it should have been. You've obviously put a case for naspers and the discounts. Are you going to change your position there, or have you cut a little bit, or are you going to add, or are you happy the way it is in the portfolio?
Firstly, just from an ESG point of view, we also weren't happy with the deal. You would have heard there's a group of investors that actually penned a letter to the naspers board, and we were part of the group of investors that signed that. So from an ESG point of view, we've expressed a view that we weren't happy with the deal, and we thought there would be better deals. Yep. One, because management's incentive was going to change to a process level. They subsequently reversed that, and it's more on a naspers level now. So that's a positive. And two, we just thought the deal was highly complex. Management debates that, but anyway, so we expressed that. That being said, the big underlying drivers of the naspers investment thesis, let's call it still Tencent and the RUM assets, which are great internet assets in the emerging markets. So great growth prospects going forward. So we think that's attractive. On top of that, you are buying it at a wide discount. So the next question is between process and naspers. Naspers' discount is at 52%. Process is at 35%. So naspers' discount is definitely wider, but there's more tax leakage at a naspers level. So right now, we still think because there will be a second transaction, you still want to be in naspers. It might take a while, longer than we expected. So let's say 2 to 3 years, but you could really see the naspers discount narrow to a process level. In a short term, you also get that you could elect to receive process in this transaction, which gives you a small uptick on 45% of your naspers position You get a 7% uptick, so 3% in your whole position. So that's interesting. And then on top of that, on a shorter term view, you can see positive flows on the naspers line. So it's included in many indices, so you should see positive flow there. Plus the company's announced a $5 billion buyback. So in the shorter term, you might see a slight repositioning into process, which we think could benefit. But on the longer term, it's probably still more attractive to be in naspers.
Yeah. I mean, we do obviously have a very big position in it. It is quite big in our index, but we really like it. We think on a long-term basis, it's very attractive. And we are running a pretty big position in that, which we think if we look out over the next 12 months, we should do pretty well.
Yeah, fantastic. Well, I think that answers the questions. We've got a few more that we'll take offline. So I just want to, first of all, thank Murray and Dwayne for your time. For that excellent presentation. I'll be circulating the hard copy or the soft copy of the presentation to the attendees, as well as the replay for those that couldn't make it or wanted to see it again. Once again, thank you everyone else for dialing in. As mentioned, the Milltrust Laurium Africa Fund is available on the Milltrust Emerging Market platform, amongst other excellent strategies, regional strategies, as well as accessible through our global fund. So with that, everyone have a great day, and you'll hear from me soon. So thanks a lot, gentlemen, and everyone for attending. Thank you.
Thanks everyone.
Cheers.